Welcome to the Monitor podcast, where we explore the ideas, innovations, and people shaping the future of equipment finance. Today, we're diving into one of the most critical and often most outdated functions in lending, underwriting. In this episode, we break down why traditional underwriting is slowing lenders down, where automation and predictive models are making the biggest impact, and how the smartest lenders are modernizing without losing the human touch. We will hear about real-world results from lenders who've made the shift and the mindset changes leaders need to stay competitive in a data-driven market. But before we jump in, here's a quick message from our sponsor.
In the fast-paced world of lending and equipment leasing, staying ahead means making smarter, data-driven decisions. Kin Analytics empowers businesses with advanced automation, tailored credit scoring models, and risk management strategies to minimize risk, streamline processes, and boost efficiency. Whether exploring new markets or optimizing portfolios, we're your partner for intelligent, impactful growth. Ready to unlock your business's full potential with AI-driven insight?
From data to done deal. Leave it to Kin.
Hi, everyone. I'm Rita Garwood, Editor-in-Chief of Monitor. Welcome to the Monitor podcast. Carolina is joining us on the podcast today. Can you introduce yourself and tell us a little bit about yourself and what you do?
Sure. Hi, Rita. Hi, everyone. So I am Carolina Patiño. I'm a product manager here at Kin Analytics. We are a data, AI, and tech company that has worked closely with the equipment leasing industry for over 10 years. And we provide solutions that help our clients save time, make better decisions, and just future-proof their processes.
Awesome. So just to get us started, let's start with the baseline. How would you describe the traditional approach to underwriting in equipment finance, and what are its most significant limitations?
So as we all know, the underwriting process, it takes various steps from application intake to credit analysis to decisioning, and each part is complex in its own. But I think I can identify maybe three main limitations there. First, I would say time-consuming and manual tasks, especially in the initial part of the application intake. That's very document-heavy. So there are entire teams that are just dedicated to manually entering data into a company's CRM, and this can be just a very boring, repetitive task that's also very prone to errors. And we see this happening with applications, bank statements, legal documents, IDs, etc. I think secondly, I would say subjectivity. So, how are decisions being made? What might seem risky to one underwriter might not seem so to another. So this inconsistent criteria across different underwriters can lead to inefficient decisions. And then finally, I would also say just a lack of access to full data. There's just so much data being generated, but rarely is it adequately collected and made available for analysts. So if you have an applicant that's a repeat client, can you see how they've performed previously? Can you look at maybe macroeconomic indicators of the industry that client operates in? Traditionally, I think analysts have used a lot of commercial and consumer bureau data to make decisions, and that's evidently very useful, but maybe giving them more customized or more detailed data can make their work a little bit easier, make them make more adequate decisions. Yeah, and then just overall kind of the results or the outcome of these limitations lead to lower processing times, less book deals, suboptimal credit decisions, which leads to more risk, more losses, etc.
So you've worked closely with lenders going through underwriting transformations. What's driving the shift from more gut-based decision-making to data-driven decisioning?
So I think one of the main drivers behind this shift is just kind of the speed and the competitiveness that we see in the market right now. Borrowers are expecting decisions in hours, not days. So lenders are under a lot of pressure to move faster with their decisioning without sacrificing quality or taking on unnecessary risks. And that's where both automation and data come into play. So kind of any improvement in efficiency, whether it be big or small, can give companies a competitive advantage. Also, I feel companies are starting to really see the value and the potential in the data that they have and how data-driven decisions can significantly improve or impact the business goals that they have.
So what kind of tools or technologies like AI or custom scoring models are making the biggest impact in underwriting right now?
On one hand, on the operational side, we're seeing object character recognition models, so OCR, LLM models, just transforming the application intake process. As I mentioned before, it's very document heavy, so these technologies can take on a variety of different PDF formats, messy formats, handwritten applications, extract the data automatically, and create a deal within your CRM. And this leads to significant improvements in response times to enter new deals. But I think one of the main technologies out there right now that's making an impact is predictive analysis. So really incorporating data, machine learning models into your underwriting process to assess credit worthiness. That's very important. We're seeing kind of a shift from a more one-size-fits-all approaches where analysts use a consumer bureau score to make a decision to a score built on the lender's own portfolio. So that way they can incorporate their specific clients' payment behavior into their modeling and just make optimal decisions for their company. And then I think kind of across the board, AI can be integrated into almost every part of the process. You can have AI-powered agents as chatbots for customer support, document validation, due diligence tasks, etc.
So right now, alternative data is a hot topic. What types of non-traditional data are actually proving useful in credit models today?
We found that industry-specific data can be very useful for credit scoring models. When we work with clients that are heavily focused on the transportation industry, we see that databases like the DOT's SAFER database can be quite valuable. This database has a lot of compliance, registration, safety information for trucking companies. So there you have fleet size, number of crashes or incidents in the past couple of years, operating status. So that can be very valuable when modeling. We've also used GPS data. So this is useful for kind of early detection systems. If you see that a vehicle or an asset is in a repair shop for a couple of weeks, that might be an early indicator that they might default. And then kind of outside of this scope, geolocation through analysis of satellite images to kind of see if where the business is located, if it makes sense with the industry they're in, digital footprint data, just deep web searches, what the website looks like, et cetera.
So we hear a lot about automation, but manual, paper-heavy workflows are still really common in this industry. Where do these processes still dominate and why?
Yeah, I think it's present throughout the whole process, but mainly in this document heavy part, the application intake. So as I mentioned, you have a lot of different formats coming in, a lot of different types of documents, bank statements, tax returns, SOS filing. You have a lot of back and forth where analysts are communicating with the customer, just requesting missing documents, and ultimately the data is all manually keyed into a CRM system, making it very kind of slow. And I think a few reasons why these processes still prevail. First, I would say just viewing these as very complex tasks that seem difficult to automate. So if you have a variety of format, it would be great if we had just one, standard format for applications across the industry that everyone uses. We don't. So having a variety just adds kind of a layer of complexity. Oftentimes you have to piece together information from various documents or other online checks as you're filling in your applicant's profile. And this just makes it seem a lot harder to automate these processes. And it does make it a little bit more difficult, but definitely not impossible. And then second, I think a big point there is just distrust in new technologies. So even the best OCR models are still not 100% accurate 100% of the time. And so when we have kind of these occurrences where something's not extracted correctly, there's a bias or there's an initial you want to reject this new technology. You don't trust it as much, even if it's given very good results previously. And then finally, just, the cost and change management behind this, a very legacy-driven industry where there's a lot of processes in place that have worked for years. So kind of making this mindset shift to another kind of technology, it's always a little bit more complicated.
People are used to doing things the way they're used to doing them.
Yeah.
So what does it take to modernize those manual choke points? Are there patterns in how successful lenders approach modernization?
I think an initial step or good approach would be first to just start mapping out every step of the process and really identify where your applications are getting stuck. Is it in the manual data entry, or is it in the back and forth with brokers and dealers? Is it in the background checks? Is it in the credit analysis? Where is it? And once you've identified your major bottlenecks, you can start to target the low complexity, high volume problems first. So for example, if you realize it's automating document workflows, you might not want to start with more complex legal documents or bank statements. You might want to start with something that might be easier, like applications that doesn't have that much high risk in extracting information. And then just a key to success, I believe, for lenders that are able to do this adequately is to always look for more hybrid solutions. So we don't want to replace humans. We just want to give them tools powered by AI and by data that can help them do a better job, take their time and actually analyze more complex cases, more critical analysis on the applications that are coming in. And this goes also hand in hand with change management that I mentioned before. It's crucial, and I think you have to involve underwriters in the whole process and not just impose a technology on them.
That's so true. So how do you strike a balance between innovation, like you're talking about, and regulatory compliance when you're deploying advanced credit models?
So I would start off first, the basics, just that the data you're using. On one hand, you want to make sure that you're eliminating any discriminatory inputs, gender, race. You don't want, obviously, to use that for your modeling. But then on the other hand, you can look for non-traditional data, like I mentioned before, to have that innovative approach there. Second, I would definitely ensure explainability. So you can combine different techniques, more AI models that perform better on a certain part of your modeling process, and combine these with more straightforward, explainable models when you develop a scorecard. And then ultimately just document everything from what data sources you're using, what methodologies you've applied, how the variables were selected, and how the model is being used for credit decisioning. At Kin, we are very focused on these being compliant. So we have GDPR and SOC 2 compliance so that our clients can be sure that when they share data with us, it's completely in the most secure way possible.
That's right. So let's talk about results. What real world outcomes have you seen from lenders who adopt data-driven underwriting in terms of approvals, defaults, or efficiency?
So we've deployed many data-driven scorecard solutions over the past years, and overall kind of an average of what we've seen are clients' results. We've seen default rates drop by around 20%, an increase in approval rates by around 30%. And definitely one of the biggest impacts we see our solutions is in the turnaround time and response time. So you have an application come in and it can be scored in seconds, and you provide the analyst with more insights, allowing them to make a better decision. We've seen response times go down by around 50%. And then on the operational side, we are excited to be building an application submission automation product, which we're seeing some initial really great results. We're looking at reducing just deal entry time by around 75%. And I'm talking just from the moment you get an email to having it in your CRM with all the relevant information.
That's great. So in the beginning, you talked about how borrowers are wanting quicker turnaround times. How does modern underwriting impact the borrower experience, especially for small or non-traditional applicants?
Yes, definitely. I think speed is everything for our borrowers from their perspective. So it's essential to get them the approval as soon as possible, the equipment so that they can start operating with the equipment. And so focusing on these small efficiency gains and being able to get that response to them as soon as possible and funding their deals, I think is definitely important in their experience right now.
So for lenders who are trying to scale without overloading their credit teams, what's the most effective place to start? You talked about kind of breaking down the processes. Would you start there, or is there something that they should do? We also talked about getting everybody on board for change management. Like, what would you suggest as a first step?
Yes, I definitely, as I mentioned before, breaking down the process, kind of mapping out your process and seeing where the chokeholds are. I think a good initial step as well as you do that, that can be done alongside, is focusing on your data infrastructure as well, because you can't build effective models on poor data. So if you start gathering and storing your data, even if you're not sure yet what you want to answer with that data or how you want to use it, if you're making sure to collect everything in the best way possible, when the time comes, when you have a clearer picture, you'll have that data ready to use it. So I think that's a good step you can do alongside. And then, yeah, as I mentioned before, kind of quick wins, looking at the low complexity, high volume. So it can be the application intake process, just anything that will have a big impact and will not be that complicated to implement.
The last question I have for you, what's one mindset shift that underwriting leaders need to make today to stay ahead in this evolving landscape?
So as I mentioned, the goal really isn't to eliminate human expertise, but to augment it with better tools and data. So I think the biggest mind shift is to think about how you can combine efficiency that comes from automation with also the expertise of credit professionals in the industry, and just going alongside with change management process sooner than later. Underwriting should be designed to say yes to the right deals quickly. And that means just calculating your risk adequately, trusting data over intuition, and just viewing tech as an enabler of better decisions and not as a replacement of human judgment.
That's great. Well, Carolina, thank you so much for being on the podcast today, sharing all of your knowledge about this. Appreciate the conversation.
All right, sounds great. Very happy to be on.
Awesome. Thank you.